Australia and around the world. Some institutional investors have responded to measuring and decarbonising the carbon emissions footprint in their portfolios. Recent examples include the French FRR and Swedish AP4, who have announced that they will take $1 billion and that will be invested in a low carbon fund managed by Amundi. Hesta, UniSuper, and others around the world have also announced low carbon or fossil fuel free strategies. The issue is highlighted by the Montreal Carbon Pledge at the PRI conference in September, a few weeks ago, under which institutional investors signatories will commit to measuring and publicly disclosing the carbon footprint of their investment portfolios on an annual basis. The tools and the research to evaluate and measure carbon emissions exposures exist, and we're going to hear about that today, and fund managers can tailor the solutions to meet investment needs. But while the concept of fossil fuel divestment seems simple, in reality, it's not a black and white issue. In Australia, it's an investment and a risk management decision that takes place in a specific legal and regulatory environment that governs superannuation fund trustees' behaviour and activities, and it should stem from a robust and established investment governance framework for sustainable growth. Today we're here not to discuss about whether or not superannuation funds should or should not or must not divest from fossil fuels, but rather about the circumstances and considerations that trustees should take into account when evaluating their investment and their risk management question.
We know now that if the carbon budget that we can expend, carbon emissions that can be expended in order to keep our global temperatures to within a band of 2 degrees rise, is 886 gigatons. But that then means that there's 2,795 gigatons of potentially stranded reserves that are being used to value companies that we invest in today. The United Nations UNEPFI investor briefing on portfolio carbon noted that for investors and companies, the regulatory environment is changing and the mandatory reporting frameworks are emerging for both companies and investors. GHG emissions are increasingly subject to public scrutiny, legislation and regulation. I noted in their document that there are over 30 countries that have a price on carbon. Civil society organisations are exerting more pressure on institutional investors to be more transparent about the ways in which they are addressing climate change. In general, there's just better tools and data available today. And that's a big change, because the tools and data are available for investors to use. Tools and data that investors can rely upon.
When you come to discharge your duties, the standard of care expected of a trustee is that of a care, skill and diligence of a professional trustee. Now I want to drill down on those words. Care, skill, diligence. Okay, we'll come back to those in a moment, but just remember those 3 words. And it's the care, skill and diligence of a professional trustee. Okay, so it doesn't matter if it's an industry fund or it's a retail fund, if it's got union reps on the board or if it's got professional trustees, they're all held to that of a professional trustee. There are similar duties placed on the individual directors. At this stage I'm talking about the trustee company itself. So it begs the question, if I've got all of these risks and I've got these duties, how do I translate the two? What we'd be suggesting is that the duty of care, skill and diligence and the duty to act in the best interests of members means really you've got to have robust processes whenever you're making any investment to assess the risk of that investment, whatever that risk happens to be. Now, I think a comment was made very early on in the piece that this debate is not political. I'll go one step further. For a trustee, it's irrelevant. The question of whether climate change is real or not is fairly irrelevant because of their very narrow focus on their duties. The real question is, are there risks associated with a particular investment? Whatever those risks happen to be in this context, risks associated with climate change. There could also be risks associated for other things. So for example, an investment in a tobacco company carries its own risks which are more community-based and policy-based. Hence a lot of funds have divested from tobacco investment. So the same sort of analysis applies here. We've got a group of companies here that have certain headwind risks associated with them. Whatever the reason for those risks may be, they exist. And trustees are then incumbent on them to be cognizant of those risks and to assess them properly.
To my first point, addressing climate risk needs to take place within an overall investment governance framework. When it comes to ESG and climate change, Mercer sees the challenge from the perspective of an asset owner who's looking to address ESG risks and opportunities throughout the whole investment process with a long-term investment horizon in view. We've developed what we call our investment framework for sustainable growth, which really focuses on embedding ESG into the overall investment governance model throughout 3 core phases. And we establish those as beliefs, policies and processes, and then portfolio. A board needs to understand what their core investment beliefs are and what that means in respect of ESG risks, including climate risk. Once those beliefs are clearly established, they can be reflected in the investment policy, the IMAs, and other governing documents. And then that also sets the stage for managing expectations with investment managers of what's expected in their portfolio. Is our client, the asset owner, just looking at investment risk and return, or are they also looking at their investment's impact on the climate and contribution or positioning in light of climate risk? At Mercer, we do see climate change as being an investment risk and opportunity, and therefore we work with clients to first understand climate change and the risks and opportunities it presents for their fund. There's still a lot of confusion around climate change. Is the science set? What are the risks to my portfolio? So educating trustees and directors is an important first step.
There's a fantastic paper that was written, and one of the guys is of course from Amundi and one's from AP4, right? And it's Matt Anderson's, Patrick Bolton and Frederick Samara, right? And it's talking about hedging climate risk. And it goes through the history. It's a worthwhile read if you get a chance, right? It goes through the history of where we've come from with green indices and what's gone wrong and where the people's experience has been across time. But the final quote, right? The uncertainty with respect to climate change and climate change mitigation policies cannot be waved off as a zero probability, right? So let's not try to frame the question to get the answer we want. They're saying, look, let's just say, is it a probability it's going to happen? If it's not zero, then you're obliged to consider it as something that you consider in your portfolio. Any rational investor with a long-term perspective, I think we can tick the superannuation funds as being rational investors and long-term perspective, should thus be concerned about the absence of a market for carbon and the potential market failures that could result from this market incompleteness, right? So that means that from those numbers I've told you, this isn't in the price, okay? People aren't acting on mass already, right? This is a tale of people that are interested in looking at it, and they're viewing this as a mispriced asset. And in fact, the terminology that we use is it's a free option, right? If you design your portfolio correctly, right? And so if you divest, agree, if you divest and you throw it all out and you get rid of it and all that sort of stuff, you've made a huge statement, but you've also made an enormous fundamental decision and exposed your portfolio to a whole range of risks and macro. That fails what Mag was talking about, assessing the risk associated with a particular investment. That shows you haven't assessed the risk retention. Right? It's not a world of black or white, it's a world of greys. And you should be able to find somewhere in this a compromise that fits.
What hasn't happened yet, and I think this is the purpose of today's talk, is it's all fine to sort of say, well, let's identify risk, but I don't think climate change has been, up until just very recently, been identified in the risky way that it has. I think most people, if you were to ask most super fund boards, what do you think about, what are the climate change risks? They would talk about global warming in a more general sense. They would talk about the seas rising and the polar caps melting. They wouldn't necessarily talk about, that port that we've just invested in, which was a major coal port, is now going to be shut down, or its business model is so greatly affected that means now a massive drop in that investment value. They wouldn't actually take that next step. And I think that's certainly for me, the interesting part of participating in this conversation in the lead up to today was to actually get that granularity, because you get this very high level sort of global picture of climate change, and it's actually when you come to look at it on a granular level that you start to realise this affects super funds on a day-to-day.
Can we just go on a tangent to that? Right? So we're talking about stranded assets. What about stranded infrastructure? Right? In Queensland, we're still building ports to export coal, right? So we're dredging harbours and we're just dumping that pesky fill on the barrier reef because it just needs to be lifted up a bit with all the extra water going around, right? So if we're building assets still to support assets that we know are going. I mean, how bad an investment are we looking at there? So yeah, we start to ask a whole series of questions that just aren't being considered.
And just picking up that point, that was something I tried to make earlier. We can't just look at fossil fuels. We have to look at everything that goes around that. And it's easier to carbon footprint equities because we have the data, but that doesn't mean the risk doesn't sit in infrastructure and private equity and these other asset classes. And although the data may be more difficult to get, the questions can still be asked of investment managers or underlying assets that you're considering investing. So I think we do need a really holistic approach to this that looks at it throughout the investment process.
MSCI has been working on this for a while, as I mentioned, and so we've been looking at it for years in terms of ESG risks. I like the way Alexis talks about these risks aren't just fossil fuel based. ESG risks expand or extend beyond that, and MSCI has been in this space for over 20 years. We have analysts around the world. We've got a couple of analysts here in Australia that focus in depth on the exposures companies have to environmental risks. And that includes focusing on, for instance, insurers, and we look at the insurance sector, and we look at insuring climate change risk, as much as we do look at carbon emission exposure of companies. So this is another way to think about the impact of climate change risk in terms of what are the emissions that a company has, Scope 1, Scope 2 emissions in its operations. And that does bring into account a lot of the other assets that the organisation uses.
But if I can just swing back just for a second onto a point about bonds and equities, right? And so I think it's a really important point because when everybody signed up for the ESG and everybody went charging down, the equity route is the easiest route for them to follow. And Mike was 100% right because everybody said it was too hard and not enough data to understand. But if the core belief in engaging with companies and engaging through taking activism, i.e. maybe selling the shares or divesting or however you want to do it, or reweighting, right, is the belief is that the large institutional investors can somehow, right, mould the behaviour of the end companies by this engagement, showing them that we're willing to walk away, showing that large institutional investors like AP4 are making these stands, right? If you only do it on the equity side, right, all you do is shut down those companies' access to the equity markets. They just go straight to the bond markets, right? They just change the way they move their own capital structure around. They release less equity, they raise more debt, okay? So you've got to sort of ring fence these behaviours, right? You've got to be, we've got to be smart as an industry and understand that if we close one door, the other door's still open, and they're just going to move from one door to the other door, okay? And so, at Amundi, right, like I said, 90% of our assets, 70% of our assets are cash and fixed income. Okay, we're not an equity house, right? 30% of our assets are equities, right? So across our entire fixed income and cash book, we're engaged in ESG, right? So to do that with companies takes them a lot by surprise in the first instance, but eventually they get used to it.
You said before, Brian, that we're only in the tail now, where we're talking about 100 billion of 3 trillion of 45 trillion. Yeah. How quickly is that wedge going to grow? So I'll start with you.
Okay. Well, there's a UN climate change conference in Paris, December next year, right? So it'll be front and centre when that's going on. So I think if we haven't managed to get their attention in the lead up to that conference, hopefully that conference will really focus their attention on. So after that, there'll be a spurt of activity. So we are at the beginnings, but I think it's a journey that's started. Like I said before.
I was surprised at the speed with which, if I go back 2 years ago, this was not something that was talked at board level at all. Fast forward, it is now. Everyone is talking about it. I think it will gain momentum even faster. I think it will be a very, very fast process. I think the slow part of the process will be actually, probably enough, implementing those processes. That is hard to do. It's hard for them to I think it's hard to understand. But once you do get on board and understand the risks and whatnot, then I think it becomes a lot easier. And I think that's where the education piece needs to come in. It's going to take a little bit of time.
Yeah, I would agree with Brian. I think there's going to be a lot of momentum up until the Paris summit in December next year. I also think there's now a much richer set of tools to address these questions. So rather than it just being
divest, invest, or just a divestment question. There are a lot of other options that clients can consider in terms of taking action on it. So I do expect the momentum to continue, and hopefully we'll see the toolbox continue to grow. I think the question of fixed income is still a bit unexplored, but that is a place where you can really decide whether you want to continue to fund some of these projects if there's substantial stranded assets risk. So yeah, I think there is more product that can be developed that will meet clients' needs in the coming years. So.
Yeah, investors have not had access to the in-depth and comprehensive analysis that they can today to assess not just the carbon risk from a Scope 1, Scope 2, but also the potential carbon risk from fossil fuels, as well as the risk management of the organisation around carbon emissions and climate change. And let's not forget, the energy substitution, what their exposure is on the more positive side. It's not just all about how they're focusing on the fossil fuels, but also they can focus on alternatives.
This is probably a question for Alexis, but happy for anyone to sort of comment. Most super funds sort of in the past and to date have dealt with a client demand around ESG by having a separate SRI option and then sort of focus their interests sort of in that option. But the discussion today seems to be sort of that it's quite important across the entire of the fund or across all investment options for members. So how important is it for funds to sort of segregate these issues in an option for clients so that clients who are particularly focused on this can invest in that option? Or do you think it's something that really should be considered across the entire fund, across all investment options?
Sorry, I didn't catch your name or your
Oh, sorry, it's
affiliation?
Joe Cornwell from State Super Financial Services.
I think this is a good place to refocus on the question of values and beliefs versus risk and opportunity. So if a super fund believes, as Mercer believes, that ESG issues, including climate risk, can present material financial risk to the fund, then the question needs to be answered with respect to the default option and not just with respect to an SRI option. If a member is writing in about a values point of view around a specific sector, then it probably is appropriate to say, well, we have this other option for you. For example, if they call about gambling, the question falls usually more in the value side, and you might say, well, have you had a look at our SRI option? But I think with the question of climate change and fossil fuels, because it brings with it financial risk and return questions, it is important to address it across the fund and with particular focus on the default option.
Thanks for a great discussion. I think it's been really illuminating. It's been great to hear discussions broader than just divestment, because I think that has potential to be misleading in some ways, because so many companies rely on fossil fuels currently, and I think we're in danger of rerunning. I think some of the debates around ethical investment and responsible investment that were around a while ago, if we just take a purely divestment-focused approach and not move capital where it really needs to go. So, just a question, just quickly while I can mention it, we are encouraging other investors to sign up to the Portfolio Decarbonisation Coalition. So anyone who's interested in that, please feel free to talk to me afterwards or get in contact with me, because we're very happy to do that. It's at no cost. Just a question for the panel. How can we, in this discussion and focus on divestment at the moment, avoid some of the mistakes that perhaps were made in those debates around ethical investment and move much greater amounts of capital into decarbonisation?
I mean, from a trustee perspective, I think reframing it in terms of risk is vital. The problem with an ethical debate is that everyone's going to have different ethical standards across the room, and if I've got 1.2 million members in my hypothetical super fund, realistically, why am I going to listen to your values or your values or your values? So I ignore them all. And I focus on the one objective, which is the easiest to measure, and that is return. Once you start talking about risk, that's a game changer there. And then now I've got my ears. Yeah, you've got my ears, and I've got to pay attention to it. And in fact, I've got a duty to, and I've got to factor it into my analysis as a matter of law. So that, to me, is the main game changer.